If you save 2 million to 5 million for retirement, you're in what I call the retirement penalty zone. You're too wealthy to qualify for most tax breaks, but not wealthy enough to ignore the costs. And here's what most people don't realize. The government has designed a series of income cliffs that can cost you tens of thousands per year in penalties, surcharges, and taxes. If you're in this wealth range, you need to see this. I'm Jay Forgione, president of Summit Retirement Solutions, and for over 2 decades, I've been helping high net worth retirees and pre-retirees create tax-smart income strategies. One thing I see consistently is people in the 2 million to 5 million range get blindsided by retirement costs they never saw coming. Medicare surcharges, Social Security taxation, and required withdrawals that push them into higher tax brackets. Today, I'm going to show you why this wealth level faces unique challenges and what you can do about it. If you find this valuable, make sure you like, comment, and subscribe. Here's what we're going to cover today. First, I'll explain why the 2 million to 5 million range is the hardest wealth level for retirement, and why being moderately wealthy creates unique tax problems. Second, I'll show you the 3 biggest financial traps that hit this group the hardest: Medicare IRMAA surcharges, Social Security taxation, and required minimum distributions. And third, I'll give you the framework to minimize these costs and keep more of your money in retirement. Let me start with why the 2 million to 5 million wealth range creates unique retirement challenges. If you have less than 1 million saved, you likely qualify for various government programs and benefits. If you have over 10 million, you can afford top-tier tax planning and the costs don't materially impact your lifestyle. But the 2 to 5 million range, you're caught in the middle, what I call the retirement penalty zone. Here's the reality. Almost every major retirement program, Medicare, Social Security, required minimum distributions, is designed with income cliffs that hit this wealthy level the hardest. According to the research from the Employee Benefits Research Institute, households with 2 to 5 million in retirement assets typically generate between 100 and 250,000 in annual retirement income. When you factor in Social Security, portfolio withdrawals, and required distributions, that income range is precisely where the government starts layering on penalties. You make too much to avoid Medicare surcharges. Your Social Security gets taxed at the maximum rate. Your required minimum distributions push you into a higher tax bracket. And unlike wealthier retirees, these costs actually matter to your standard of living. Here's what makes this even more frustrating. The income thresholds that trigger these penalties haven't been adjusted for inflation in decades. The Social Security taxation threshold was set in 1984. It's never been updated. So every year, more retirees in this wealth range get hit with taxes and surcharges were originally designed for truly high-income households. Let me show you the 3 biggest traps that hit the 2 million to 5 million range hardest. Trap number 1, Medicare IRMAA surcharges. IRMAA stands for Income-Related Monthly Adjustment Amount. It's a surcharge on top of your Medicare premiums. If your income exceeds a certain threshold in 2026, the threshold is $109,000 for single and $218,000 for married couples. Here's the problem. IRMAA uses a cliff system. If your income is $217,999, you pay the standard Medicare Part B premium of $202.90 per month. If your income is $218.01, just $2 higher, you pay $284 per month. That's an extra $81.20 per month, or $974 per year per person. For a married couple, both on Medicare, that's nearly $2,000 a year, triggered by $2 of income. And it gets worse. IRMAA uses a 2-year look back. Your 2024 income determines your 2026 Medicare premiums. So you can't even adjust in real time. You have to plan 2 years ahead. Trap number 2, Social Security taxation. Up to 85% of your Social Security benefits can be taxed as ordinary income. The thresholds where this kicks in is $32,000 of combined income for a married couple. That threshold was set in 1984 and has never been adjusted for inflation. If you're in the 2 to 5 million range, you're almost certainly over this threshold. That means 85% of your Social Security is taxable. For couples receiving $60,000 per year in Social Security, that's $51,000 added to your taxable income on top of everything else. Trap number 3, required minimum distributions. Forced taxable income. Age 73, you're required to start taking minimum distributions from your traditional IRAs and 401ks. If you have $2 million in tax deferred accounts, Your first RMD at 73 is roughly $75,000. At 4 million, it's $150,000. Here's the problem. You might not need that income, but the IRS doesn't care. You have to take it. You have to pay the tax on it, and this counts towards your IRMAA threshold and your Social Security taxation. It's forced taxable income whether you want it or not. Let me show you what this looks like with real numbers. This is a hypothetical, but based on situations I see regularly. You're a married couple, both 70 or older, with $3 million in retirement savings. $2.5 million is in an IRA, $500,000 is in taxable accounts. You're both on Medicare. You're receiving $60,000 per year in Social Security. You need $120,000 per year to live comfortably. Scenario, poor planning. You take $60,000 from your IRA to supplement Social Security. Because your income exceeds the threshold of 85% of your Social Security, $51,000 becomes taxable to your income. Your total taxable income is $111,000. $60,000 IRA withdrawal, $51,000 taxable Social Security. At 22% federal rate, that's $11,222 federal taxes on your Social Security alone, plus another $13,000 on your IRA withdrawal. Right now, you're below $218,000 at IRMAA threshold for married couples, so you pay the standard Medicare premiums. But here's the problem. In 3 years at age 73, when your RMDs kick in, now you're forced to take $94,000 from your IRA, add to the taxable portion of your Social Security's $51,000, and your taxable income jumps to $145,000. You're still under the married IRMAA threshold for now, but if you have any additional income, capital gains, part-time work, investment income, you could easily cross the $218,000 and trigger an extra $1,948 per year in Medicare surcharges from both of you. And that threshold gets harder to avoid every year as RMDs increase and your account balances grow. That's the trap. Forced withdrawals pushing you closer to the cliff every single year. If you were realizing these traps could apply to your situation, or you're already dealing with IRMAA surcharges and forced RMDs, that's exactly why retirees in the 2 to 5 million range plan around these cliffs. Click the link in the description to schedule a conversation. Now, I know some of you are thinking, I should be grateful to have 3 million saved. Absolutely. Having 2 million, 5 million saved for a significant accomplishment, but that doesn't mean you should overpay in taxes and surcharges. The goal isn't to complain. It's to be strategic. You've spent decades saving this money. You should keep as much of it as legally possible. Can I just spend down my IRAs before 73 to avoid RMDs? You could, but you'd be paying taxes now instead of later. And you might push yourself into IRMAA surcharges early. The answer isn't to avoid the problem. It's to plan around it. Strategic Roth conversions in lower income years, tax loss harvesting, and coordinating withdrawal strategies can help you control your taxable income and avoid crossing these cliffs. So what should you do? Here's a 5-question framework to protect yourself in the 2 to 5 million range. Question 1, do you know your IRMAA threshold for 2 years from now? Remember, 2024's income determines 2026 Medicare premiums. If you're close to a cliff, plan your income 2 years ahead. Consider delaying Roth conversions, managing capital gains, or timing income to stay below thresholds. Question 2, how much of your retirement savings is tax deferred versus Roth versus taxable accounts? Tax diversification matters. If everything is in a traditional IRA, you have no flexibility. Build Roth balances in your 60s and early 70s before RMDs start, so you have tax-free income options later. Question number 3, are you maximizing tax-free income sources? Roth IRA withdrawals don't count towards IRMAA or Social Security taxation. Neither do qualified charitable distributions after age 70 and a half. Use these strategically. Question 4, when should you claim Social Security? Delaying Social Security to age 70 increases your benefit, but it also increases the taxable amount. Run the numbers. Sometimes claiming earlier and doing Roth conversions makes sense. Question 5, do you have a multi-year tax projection? You can't plan year to year in this wealth range. You need a 10-year income and tax projection that accounts for IRMAA, cliffs, RMDs, and Social Security. Here's the bottom line. The 2 million to 5 million wealth range is the retirement penalty zone. You're too wealthy to qualify for breaks, but not wealthy enough to ignore the costs. Medicare IRMAA surcharges, Social Security taxation, and required minimum distributions all hit this group the hardest. And the income thresholds that trigger these penalties haven't kept pace with inflation. This doesn't mean you can't retire comfortably with $2 million to $5 million. It means you need a plan. You need tax diversification. You need to understand the cliffs and plan around them. And you need to stop thinking year to year and start thinking in decades. The good news is these challenges are solvable. With strategic Roth conversions, coordinated withdrawals, and proper planning 2 years ahead of IRMAA determinations, you can keep significantly more of your money. You just need to know the rules and plan accordingly. If you want personalized help building a retirement income strategy for the 2 to 5 million range, one that accounts for Medicare surcharges, Social Security taxation, and RMDs, let's connect. We'll review your accounts, your timeline, and create a multi-year tax projection. Click the link in the description to schedule a conversation with me. Thanks for your time. I'll see you on the next video.